Good morning, traders and investors. It's Roger Scott, Senior Strategist for Wealth Press. Today's Tuesday. It's May 30th. It's almost the end of May. I'm not even sure if May is 30 days or 31 days. Let's see here. We'll find out soon enough. Yeah, it has 31 days. Tomorrow is the 31st. As you can see here, the market is on the Dow. It's just down 8 ticks, pretty random. But on the Nasdaq, it sure isn't. It's up almost 200 points. That's equivalent to the Dow being up about 400 points. So you could tell we're going to have a tech-heavy day. But don't get too excited, because after what I show you today, you may not be this excited about tech, or you may realize that it's time to start taking profits off the table on those juicy tech trades you've been trading to the upside. Now, as far as the week ahead is concerned, yesterday was a holiday. I hope everyone had a nice holiday weekend. I had a nice barbecue with T-Buzz. It was great. Should have taken some pictures. But anyhow, today you got consumer confidence. It's coming out in about 2 hours and 8 minutes. That's going to be a huge, huge report. You've got Susan Collins speaking. You've got the Chicago PMI. You've got the jobless claim. You've got the manufacturing and employment data. Not a huge week for Fed news. Not a huge week for trading action, because it's a fragmented week. Now, what is a fragmented week? Anytime you have a holiday, especially a big holiday like Memorial Day holiday or Labor Day or 4th of July, the week tends to start off very, very slowly and doesn't really get cracking till about 2 days after. So I'm expecting normal volume and volatility to begin around Wednesday afternoon, Thursday morning, depending on what the market's doing. So that's the first thing I wanted to tell you. But the consumer confidence report is going to be a very interesting report, because I want to see how it will reflect on the economy in light of the fact that bond market is completely changing its tune. And I'll talk about that and Mr. Squirrely, aka Powell, in just a few minutes. Now, just to give you a heads up, these are the earnings that are coming out this week. And if you're interested in this, I'll be sharing this in my VIP room today at noon, as I usually do. And if you're interested in this, I'll send you an email with this. Just like our channel, subscribe to our channel at YouTube, and send me and our Telegram channel, and send me a note. And I'll send you a link to this. But these are all the earnings. But the number next to it, this is the interesting part. This is the volatility. This is the expected range as built into these stocks. So Tuesday you got Hewlett-Packard. Wednesday you got CRM. You got Chewy, Okta. So you could see here, Hewlett-Packard, the expected move either up or down away from the current price. The volatility that's expected is 6.3%. So if the earnings overcome that, this is what's baked into the option right now. This is the implied volatility. So you can see MasterCard is expecting a 12.7% move. That's quite a lot for a non-tech stock. You got AVGO, a chip stock, expecting less than MasterCard in terms of volatility. Dollar General is only expecting 5.5. So you could see all this here, Chewy, Okta, and these are the companies that are coming out with earnings this week. Now, this is not earnings season, but you can get a good idea. Hewlett-Packard, Salesforce, CrowdStrike, Chewy, Okta, Lululemon, Zstrike, Dollar General, MasterCard, and CHPT. It'll be very interesting. And again, if you're interested in this sheet, just send me an email. But I try to do this for you on Monday so you can prepare and see which stocks. Obviously, I don't do this on earnings season because I would have to go through 100 stocks. But this is a simple implied volatility graph of what's expected and what's priced into the price of the stock. So if you think AVGO is going to move 20%, buying calls and puts on them may not be a bad idea, because the expected move is only 8.2%. I'm not suggesting you do that, but I'm saying that that's one way to play this, or selling options away 8.2% away from AVGO, assuming that you don't believe the move is going to be that big. Now, as I mentioned, we have the employment data to look forward to on Friday. One of the assets I want you to keep an eye on is the bond market. Why I want you to keep an eye on the bond market? Well, first of all, if the debt ceiling fiasco is in fact solved, it's going to relieve some pressure on interest rates, and interest rates are going to go lower. And if interest rates go lower, then bonds go higher, which is one of the reasons why tech stocks are so strong. Notice it has a nice little turn here on the 5-day RSI. I think this is the 5-day RSI. Yeah, it is the 5-day RSI. And I like the 5-day RSI for market timing. As you can see here, these are turning points right here. And it looks like this is a turning point because we're near support level as we speak right now. The bond market's expecting to open up about 82 ticks higher. So the bond market is supposed to start moving back into the upper end of this range and move higher. I'm expecting that unless there's some fiasco that we're not aware of from the government. Now, in terms of data, let's talk about what we missed over the weekend. So S&P is flat. The Nasdaq, well, S&P is not flat. It's actually up a bit because the Nasdaq is up, and that's 20%. So you could see here the S&P is up quite a bit. But the Dow, I meant the Dow, it's flat. It is flat, 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 flat. All the money is going into the tech stocks, not the blue chip stocks, which makes zero sense. Because if there's no default, the money should be coming back into consumer staples and utilities and things that we need not want. But the AI generation is just fueling those tech stocks, those chip stocks like there's no tomorrow right now. President Joe Biden, Sleepy Joe, finalized a budget agreement with Kevin McCarthy to suspend the $31.4 trillion debt limit until July 1st, 2025. Gives us a little bit of time. And caps some federal spending to prevent a catastrophic U.S. default. Come on, guys. You know they were going to solve this before any kind of default. The economy is just too weak not to handle a default right now, just like it was in 2011. Biden said that finally U.S. debt ceiling deal was ready to move to Congress for a vote. However, a handful of Republican lawmakers said Monday they would oppose the proposed debt ceiling. Of course they would. Nasdaq is now at a 13.5-month high, grossly overbought. I'll talk a little bit about that in a minute. Workday surged about 10% after they came out with earnings. Marvell Technology, another chip stock, did really well. Chips are on a roll right now. Be careful, they're a little overbought. And Ulta Beauty didn't do well because people aren't spending as much money on beauty supply stores. They did for a while after COVID. Friday, we had core PCE data. It was better than expected. We had personal spending. It was better than expected. And consumer sentiment was also revived higher. And today, we've got consumer confidence. Now, that's a very, very interesting report in light of everything. Now, here's where things get really interesting. And this is what you get for listening to Powell. Remember, I thought that the odds of not having a rate hike is just ridiculous? Well, look at what Mester said on Friday. She would not rule out hiking interest rates at next month's central bank meeting. Everything is on the table in June. Inflation is still too high, and it's stubborn. Now, does that sound to you like what Powell said? Didn't he say we're going to pause? Did he not say we're more than likely going to pause? And wasn't the odds of no rate hike at 90%? Wasn't it? Well, it's at 38% right now. Matter of fact, you know what? I'm going to take a screenshot of this before it disappears into the abyss so I could show everybody in my VIP room this later today. This is here. Let me just do this right here. There we go. All right. Now it's on record. So you could see here now, I'm not crazy. 61% of a 0.25, and I think this number is going to increase. I think there's absolutely no reason to pause rates right now. And if they do pause rates, they'll make up for it later on. They simply want to see where things go. They're not doing this because things are getting better. Fed officials will make appearances next few days. We'll get a little more yearful from Barkin, from Harker, from Collins, from Bowman and Jefferson. And so far, the only one that's really talking about keeping things at bay, or was a month ago, was Mr. Squirrely Powell. I told you don't trust that guy. Remember 90% no rate hike? Now it's in the, 38%? Again, U.S. consumer confidence is what we're looking at. We're looking at it to come at 99. That's not that high of a number. Last time it came in at 101.3. The Fed data has been beating expectations. Europe is up as investors are happy that the tentative deal reached by U.S. lawmakers, tentative. Let's not get too excited. Let's not start dancing up and down yet. But data on Tuesday showed that Spanish inflation fell more than expected in May due to falling fuel prices. That's very interesting. And I think fuel prices are a little bit overdone in my opinion. China flatlined as they're looking at sentiment. And sentiment between Washington and Beijing is not getting better. They're doing all sorts of stuff to stop limiting production. And, honestly, if I was China, I wouldn't be looking at a gift horse in the mouth right now because they're not doing well. And from what I'm understanding, they're having another bout of COVID. They still are having a very hard time recovering from the previous bout of COVID. They're just not doing that great. And they were posturing that they were, but that song and dance finished a long time ago. Japan, Nikkei close higher for the fourth straight session. Optimism for more investment in the semiconductor industry. Yeah, don't hold your breath. That they may have to wait for a little pullback. A panel offered a revised country's chip strategy to boost the development of energy-efficient chips for generative AI. AI. You've got NVDA got upgraded again. Remember, the market cap on there is over $1 billion now Ford's looking good. I'm glad I didn't short those car stocks. We'll have to see what they have to say, and we're having a few more earnings today, including HP, U-Haul, and Catalent. Now, we're short this stock. Their earnings got revised, pushed back. So they are not supposed to report today, but I think they're reporting. I'll double check on that, but I think we're short this stock right now. I'll have to double check on that. Now, I already mentioned the bond market's looking like it's going to go higher, which will relieve pressure on interest rates. Now, I want to show you guys something. This is the technical chart of consumer staples. Consumer staples went from 77 to 73. They are fully in support, and they are. I want to show you how oversold they are. These suckers are more oversold. Look at this graph. They haven't been this. That's a weekly. Let me see how far back it goes. Let's see. Let's see what the oversold level is again. Let's see. Negative 5. Let's see. Was the last time they were at 5. 10, 7. Here we go. Oh, this waterfall right here. 3. So the last time they went this oversold was in February 2020. This is the COVID breakdown from what I understand. They haven't been this oversold since. Now, that's the technicals. Look at how they are technically. This is a pretty nasty corrective pressure right here, taking us all the way down to the base. But look at consumer staples on the momentum levels. Looks like they're flatlining. Looks like they bottomed out. Looks like it's time to start buying. Well, like look at utilities. Same thing. Utilities haven't been this oversold. Let's see. We're at 7 point. Let's see. Same thing. Look at that. 1022. Look at this downside we had in utilities. This is how low they are right now. Like this. I mean, this is really, really nasty. And it looks like they're bottoming out too. Now look at utilities here. Let me show you this. Look at where they're at. It doesn't look like they're going to go much lower. Now, does that mean they're going to go higher? Not so sure, but I don't think they're going to go lower. Now look at Infotech. Look at where we're at. And look at the assets are making swing highs. Technicals cannot even muster that level. This is overdone. Really, really overdone. Now, I know I've been saying it for a week or so, and I wasn't expecting NVIDIA earnings to come out as good, but chips are what's driving this right now. So I'm expecting downside on technology, an upside in utilities and consumer staples. The Nasdaq 100 right now is not as overbought because if you look at it equally, you will see that this breakout that you're seeing is very concentrated. See that? This is where the real Nasdaq is right now. This is where the regular capital weighted Nasdaq is right now. So this is capital weighted, and this is equal weighted. Very, very different. And again, divergence right here. Look, it's making higher highs. It's making lower highs here. Everything is pointing to corrective pressure to the downside. So expect this market to turn. Now, this week is going to start out a little slowly. I'm expecting bonds to rally. I'm expecting tech to start cooling off, and I'm expecting utilities and consumer staples to start moving higher. I think the market is overbought right now in terms of technology, and I think the fact that the Fed may, in fact, be raising rates is going to shift the dynamics and cause the technology sector to cool off a little bit because that wasn't priced in, and now it's being priced in at over 60%. Here, I have proof of it right here, 61.8%. So don't fall for a banana in the tailpipe as far as I'm concerned. And most importantly, like this video, subscribe to our channel, comment and feedback. I want to hear from you. And by the way, Mia is recovering well. I'm going to send some pictures of proof of life on my Telegram channel today. Remember, bonds higher, utilities and consumer staples may be done going down, and technology looks like it may be fizzling out after today's rally. I'll talk to you guys later. Have a great, great week ahead. Bye.